Hi everyone, this is Vinod here. In today's video, we'll be looking at Crowdstrike's technical analysis. These are the things that we'll be covering in today's video. We'll be looking at the technical analysis of Crowdstrike on a daily time frame. We'll also be looking at the technical analysis of the Crowdstrike on a weekly time frame. We'll look at what is driving the strong price action and what is the news behind such a strong price action that is happening in the Crowdstrike stock price. We'll also look at some of the mistakes that traders and investors are currently making, and finally we'll conclude with one of the important lessons that we can take from this one, which is the rule of 200-day moving average. So we'll look at technical analysis on a daily time frame. So when we look at Crowdstrike's price on a daily time frame, we can see that the price is crashing down and sellers are clearly in control, and we can see that there are huge volumes on the downward there are huge volumes showing that the major investors and institutional investors are trying to exit this particular stock, which is driving the downward momentum. So at one point, Crowdstrike used to be one of the darlings of tech rallies, and it used to be in the top 1% of the Nasdaq 100 index. Like it had a strong price action show in the upward momentum, but due to the recent developments, the price has been going down and showing a momentum in the downward direction. So now let's look at Crowdstrike's price on a daily time frame. So here we can see, like I said, it used to be on a strong upward momentum till about July, and then in the third or fourth week of July, there was some developments which actually caused the price to skyrocket downwards towards a downward direction. And as we can see on a daily time frame, the price is below the 200-day moving average, and there are huge volumes. As you can see from here, there are huge volumes showing that the major institutional investors are trying to exit this particular stock. Now let's look at the price action on a weekly time frame. So here we are looking at Crowdstrike on a weekly time frame chart, and the story is pretty much the same on the weekly time frame as well. As you can see, there is a strong price action then there is a strong selling pressure that is coming after the recent developments, and the volume is also huge, showing that a number of investors are trying to exit this particular one. Now there was a strong upward momentum rally because the markets are always forward looking. Now, since the third week of July, there has been uncertainty about Crowdstrike's future growth prospects and about how it will survive this kind of bad reputation that has come around it because of the IT outage. And that is the reason why there has been a strong selling pressure. We have to remember that the markets are always forward looking. The market doesn't care about what happened previously and what was its growth prospects previously. It factors in what are the future growth prospects and what does the future of Crowdstrike look like. So it doesn't look very optimistic, and that's the reason why investors are trying to exit this particular one. Now let's look at the news that is driving such a strong price action in Crowdstrike's Crowdstrike. It used to be one of the top it used to be in the top 10 ranks or top 1% cohort of the strong momentum stocks in the Nasdaq 100 index, but right now the price action is showing that the sellers are clearly in control of the market now. And the reason behind this was because the news that Crowdstrike was the reason behind blotched IT update, which caused the Microsoft operating system to shut down on a lot of critical systems like airline operations, hospitals. There were a lot of Microsoft operating systems that were using Microsoft operating system which had crashed because of the patched update or a wrong update from Crowdstrike. And this was the main reason that caused the strong price action. Now in this one, we look at some of the mistakes that traders are making. So one of the first mistakes is catching falling knives, and because of the FOMO, like they missed out on the rally that Crowdstrike had. Now there are a lot of investors who are trying to catch falling knives, which is never a good idea. And the second mistake is that people are listening to opinions. Like there are a lot of media news articles and TV shows which say that the CrowdStrike's price might have bottomed out and now is the right time to price. Or there are some research analysts who are making some positive or trying to make some positive commentary around CrowdStrike's future growth prospects. But we need to remember that these are all just opinions, and we shouldn't be basing our investment decision based on the opinions of. If we shouldn't listen to the opinions, then whom should we listen to? So that brings us to the third point. We should be listening to the market. What is the market telling us? We'll be better off, we'll be more profitable if we listen to the market. Like the market is now telling us that there is uncertainty around CrowdStrike's future growth prospects, and that's the reason why the major investors are trying to exit this particular one. So the current price action is clearly the market is telling us that it is not a very good stock to be invested in right now. The fourth mistakes that I've seen people make is they hope for a break even or a turnaround. Hope in the markets is a very bad idea. We hope for a break even or a turnaround mainly because of the pain associated with taking a small loss. And once we refuse to take a small loss, what eventually happens is that the small loss grows on to become a bigger loss. So never hope for a break even or a turnaround. Accept the small loss and move ahead to the next trade. The other mistakes that I've seen people is that because of their they have already invested some money, and then they try to avoid the pain around the loss. They try to average down. There are some very good advice around when you should average up and when you should average why averaging down is a bad idea. So you can always average up, like meaning if a stock is going in the right direction, like suppose if you are sitting in the right bus and if it's going in the right direction, you'll continue to sit on it. But if you got onto a wrong bus and if it goes in the wrong direction, we don't sit on the bus. We just try to get off at the next stop and try to get onto the bus which goes in the right direction. So averaging down is a very bad idea, and it will also lead to maximizing your loss. Then another mistakes that I see people make is they try to revenge trade because they lost some amount of money in this CrowdStrike. They try to look for bottoms, or they try to catch the bottom and then try to make some money out of it. There are some also like this is mainly because of their behavior around trying to make money from the same stock in which they lost. But there are some very good professional traders who say that if you lose money in X, it's not mandatory that you have to make money from X only. You can make money from a different stock. It's better to accept the loss and move on to the next trading setup or the next investment opportunity. So revenge trading or trying to catch a bottom from the same stock and trying to make money out of the same stock is a very bad idea. So these are some of the mistakes that the traders are making, which are trying to catch falling knives, trying to listen to opinions of analysts, and not listening to the markets, hoping for a break even or a turnaround, and trying to average down to this is also a result of trying to they want to average down so that they can exit at a break even, which is also not a very bad idea. And some of them, they try to do revenge trade because they lost certain amount of money in this. They try to make the same amount of money, or they're trying to win back. They take it personally because of their ego. Then they try to revenge trade the same stock. So these are some of the mistakes that people are making. Yeah, now let's look at the rule of 200-day moving average. So this is a rule that will save you a lot of money, and it is commonly referred to in the trading circle as the rule of 200-day moving average. So what does the rule say is that nothing good happens below the 200-day moving average. As you can see from the daily chart, the price is currently below the 200-day moving average, and it's best to do nothing, not touch any stocks which are below their 200-day moving average, because nothing good happens, nothing good materializes below the 200-day moving average. Some people also use the 200-day moving average on the index, and then they try to use it as a regime filter or an index filter. But you can also apply it on an individual stock level, and you can see that the price is currently below the 200-day moving average, and nothing good happens when the price is below the 200-day moving average. So those are the things. And if you found this video helpful and insightful, and if you learned something new, if you are aware of some of the mistakes that traders are making, please do subscribe and like this video so that I can continue to make more videos. Thank you for watching.